What's up everyone, it's Caddy with Moneyvest. So in this video, we are going to be talking about a research report from one of the analysts warning for a 60% crash or sell-off in the markets. I gotta say, like, this analyst from a Wolfenbarger, John Wolfenbarger, the founder of investing newsletter Bulls and Bears Profits, does kind of lay out some quality information, but all in all, it is, again, kind of a little bit of a hit piece on the market, suggesting for the markets to sell off. So hope you all enjoy this video. I'm going to be going over the market updates and some technical updates later today. I'm kind of catching up on everything because I'm back in Dubai in my home office. So hope you all are doing great. As always, if you enjoyed this video and find it helpful, make sure that you drop a like. I would really appreciate that. And of course, subscribe to the channel if you're just joining us for the first time. And links to our Discord and Patreon is going to be down below. More importantly, the early access to the Moneyvest platform, the beta launch, which is going to be an internal launch, is happening in 1 month. So link's going to be down below if you want to join and get access to 51% discount, and this pricing is going to be locked for you forever. We're going to be paying for a lot of data fees related to all the data that we're getting from New York Stock Exchange, NASDAQ, real-time quotes, fundamental data, financial statements, everything that we're getting. Your pricing will be locked at no additional cost. All the additional features and tools and functionality will be added for free. So 51% off, and including a 16% annual discount that's available with limited time and limited spots. Link's going to be down below. And this right here is just a little bit of an example on what you can expect. This is the Moneyvest platform, still under construction development, and we're going to be doing the beta launch internal access to all the members later this month and early July. So this is basically me plotting all the revenue, profits, operating income, net income for Apple right now is what we're looking at. So again, you can kind of pick and choose exactly what you want to plot for. So let's just go over to cash flows. Let's say that you want to plot for free cash flow for Apple. Now you've got net income and free cash flow for the company. Pretty cool. You can also go over to quarterlies, and you can look at the last, let's say, 12 quarters or 8 quarters, and that will also come up as well. So the only thing is that we got to replot those things. I'm still working on some of the bugs that need to be fixed. So go over to income statement, net income again, and there you go. Now you've got the last 8 quarters worth of total non-cash items, free cash flow, and net income as well. And also we've also got Moneyvest metrics, which I think is very cool because you can kind of toggle between all the different years, and these are all the check marks that I've put on individual stocks based on a criteria. You get an M score, which is the Moneyvest score, and slow growth, high growth, worsening or compressing margins. We've got highly efficient or stable margins here. We got financial health, whether it's good, excellent, not so good, worsening, whatever the case might be. And this is the valuation, whether it's trading at a cheap valuation, premium, or a little bit of an expensive valuation as well. So again, links going to be down below if you want to join. And as always, there is going to be a huge discount if you want to take advantage of that. So going over to the report. So it's been near frictionless 7 months for the S&P 500 with the benchmark index up a cool 26%. So stock market crash, 60% downside for S&P 500. Expert warns, and this is again from John Wolfenbarger, the founder of Investing Newsletter, and former investment banker at JP Morgan Merrill Lynch. In a recent note, he laid out several charts showing why stocks could be in the process of topping out as the threat of a recession looms as well. So this right here is one of the conditions as he's suggesting. So the first, he draws on history. In prior Federal Reserve rate hiking cycles, stocks have continued to rise until around the time the central banks starts to cut. So that is true back in 2007 and even 2000's dot-com bubble. You'll notice that as soon as the Federal Reserve started cutting interest rates is when the markets absolutely got destroyed and started selling off aggressively in the tune of 20, 30, 40, 50%. But as soon as the Federal Reserve has started easing policy, the market has run into trouble. Such was the case in 2000 and 2008, two of the biggest market sell-offs in history. With the Fed expected to start cutting rates later this year, it could spell trouble for stocks. Now, the only key difference here that I want to point to is that in those times, the Federal Reserve cut interest rates because there was an underlying issue with the markets, with the economy, and they were expecting a recession. So you see this gray sort of background, that means the economy was in a recession. So this right here also is a gray rectangle. That means the economy was in a recession. And what happens in a recession is unemployment goes up. right? More and more people are not having jobs. They don't have jobs, so unemployment goes up, and the Federal Reserve needs to come in to help support the economy by lowering interest rates. And as a result, there's economic boom, and there's more stimulus, more quantitative easing, and eventually everything is back to normal. But this time around, we don't know whether we're going to run into a recession or not. Of course, if there is a recession, we've got bigger deals, bigger problems to deal with. But if there is a recession and the Federal Reserve starts cutting interest rates, yes, there is a possibility the markets tumbles once again because higher levels of unemployment. Recession means lower levels of earnings. And speaking of unemployment, he says that unemployment starting to tick higher. And the chart below shows that unemployment rate has crossed above its 2-year moving average and represented in black and red. And the last 3 times that happened was in 2001, 2007, and 2020, when the last 3 major recessions started. And the bottom part of the chart shows corresponding S&P 500 price action. And when the unemployment rate has significantly trended upwards, stocks have fallen meaningfully as well. So now what we're seeing is, again, these are what they're pointing to, that the unemployment rate is now crossing above its 2-year average or simple moving average. And now, once again, this I would give definitely some value. There is quality in this analysis because every time it's kind of proceeded in the past, when it's kind of crossed over this 200 SMA, we have seen high levels of unemployment that have followed, within a few months. And this right here, of course, was the big spike during COVID. So it's possible that unemployment starts to tick up and gets up to 4.5%, 5.5%, which obviously would be a very much of an alarming bell for the Federal Reserve, and they would need to start looking into cutting interest rates to help support the economy. But again, the topic of discussion then becomes, what are they going to help? Or what are they going to support? Are they going to support bringing unemployment down, or are they going to support bringing inflation down? What is going to be the main focus at that point? Really, the game that the Federal Reserve is playing, that the unemployment, by the time it goes up, inflation is already down. So what they can do then at that point is lower interest rates because inflation is already down, and then all they need to focus on is bringing unemployment back down. So that's the game that they're playing. They're really just trying to balance the act of making sure that unemployment does not go up till the time they're trying to bring inflation down. Because if inflation stays up, unemployment starts to go up, then there's a much bigger problem, that the Federal Reserve has to deal with. Then they have to really pick and choose between their own dual mandate that the Congress has set forth for them. So there's definitely some analysis, some value in this analysis, because we are starting to see the unemployment rate tick higher a little bit and pushing above its 2-year moving average, which every time it's happened in the past, that's followed that up with a recession as well. And finally, corporate earnings are another important indicator to keep an eye on when trying to identify a peak. While earnings were just fine in the first quarter, if they start to decline alongside a slowing economy, stocks will go with them. So again, if unemployment goes up, recession happens, then earnings obviously will come down as well. And as a result, S&P 500 will all of a sudden start looking too super expensive, and valuations will go up. And they will need to readjust, so prices will come down in order to readjust for that lower earnings and lower valuations as well. So it all adds up to give Wolfenberger fairly a dire outlook for stocks going forward. He sees the S&P 500 declining by more than 50% when all is said and done. And this is in part because of what he sees as investor exuberance and complacency. CAPE ratio obviously trading at levels we haven't seen since 1929. And another chart that he shares is this, that during the prior yield curve inversions, also something that we have talked about, that once the yield curve inverts, that's a signal for a recession that's going to happen. It's when the yield curve starts uninverting is when the recession usually begins. And this is the 10-year versus 3-month yield curve inversion. And the duration of that inversion really dictates the severity of that recession. So in other words, the longer the yield curve stays inverted, the more severe, the bigger the recession has been. In the past, as you can see, 1929, over 700 days, that yield curve was inverted. 2008 and 1974, over 500 days, that yield curve was inverted. So again, the degree of those recessions and degrees of those sell-offs were far greater than the levels we've seen before. In 2000, again, almost the same drop as 2008, but less than 300 days, or just about 300 days of inversion. This right here, 1979, so a little bit longer, 400 days, almost 400 days, and about a 25% decline in the S&P 500. And again, a lot of those plots are here, shorter durations and also less severe in terms of the sell-off. And right now we're already at 580 days, which is going to put us somewhere around here. And on average, that could mean anywhere between 40 and 50%. So this analysis, again, is simply based on the data that we have seen before, but the history doesn't repeat itself. It does rhyme though. So whether or not Wolfram reviews come to fruition depends on how long the economy can hold on as long as the Fed continues its tightening efforts. As of now, at least, the resilience shown by the jobs market and consumers has rewarded bulls generously as well. So if you go over to our own certain analysis and estimates that we also look at. So volatility is one big factor. Again, it's trading at historical lows at 13.3 in the 18th percentile. This was obviously at really rare levels, down to 6th percentile in the 12 and 11 range, levels that we haven't seen in over 5 years. Then if you come over to S&P 500's valuation, and by the way, all of this eventually is going to make its way over to the Moneyvest platform, which again, you all can access. So eventually it's all going to be available. There's going to be a macro dashboard that you can also access right next to Analyzer, and you'll be able to see all of our research and analysis over there as well. But you can see that, based on today's levels, 52.77, the market's trade at 23 to 21 times earnings multiple to as much as 19 on a 2025 basis. So, no, I don't think the markets are overvalued or expensive by any means. They are somewhat, I would say, borderline expensive to somewhat fairly valued right now, trading at 20, 21 times earnings multiple. But yes, there is this big debate of whether we see a recession or not. And I think that's really what's being debated right now in investing communities, among media, among different analysts and strategists, whether the economy survives a recession or not. Because if there is a recession, unemployment goes up and, earnings start to come down, the markets will find its way lower. Because during times of recession, it's really markets sell off anticipation of that recession. But during that recession, it's usually the best time to be buying. It's usually the best time to start deploying cash and start dollar cost averaging and really go heavy as you can go into the market, start buying up assets. Because as we understand, if there's value there, if there's high quality assets trading at very, very discounted prices and levels that we think are going to be super cheap, then eventually once that recovery begins, we're going to be very handsomely rewarded as well. So the idea is that don't predict, trade and invest based on the information that you have today. Right now, all I can tell you is that markets are trading at somewhat expensive to borderline fair value levels, but there aren't as many deals as there were back in, let's say, April 20th. That's when the last serious buying opportunity there was, or going back as far as beginning of this year, or even further back to October of 23. So there aren't as many great opportunities right now. Risk rewards are not that favorable, speaking broadly. Of course, there's individual stocks and smaller pockets within the market where you can find opportunities, but broadly speaking, there's not a lot of great buying opportunities at the moment. And right now I'm just sitting on about 16 to 18% cash, and we'll be looking at deploying that money into the market when there is opportunity, when there's more potential favorable risk reward trade-offs in the market. So hope you all enjoyed this video and found it helpful. Make sure that you drop a like, and again, don't forget to subscribe to the channel. Links to our Discord, Patreon is going to be down below. 51% off for the Moneyvest beta launch if you want to get access to this platform, and again, take a look at all of this yourself and play around with the software. Help us build something that's truly amazing, and there's going to be a lot of functionality, tools, research, and data available to all of you. As always, happy investing. I'll see you all in the next video.